Hello and welcome to our August virtual coffee talk, an update on partnership audits and the IRS Campaigns Saga. Before our webinar begins today, I would like to go over a few housekeeping items. In case you did not know, you can earn 1 CPE credit by attending our presentation today. To receive the credit, you must stay connected to the webcast for the entire presentation and participate by responding to at least 3 of our interactive questions. Please note that these questions are only accessible for a limited time during the presentation, so be sure to select your answer as soon as the interactive question becomes available. You will receive an email within 5 business days with instructions on how to access your CPE certificate. We also invite you to complete the course evaluation that will occur at the end of this webinar. We appreciate any feedback that you give to us. And with that, I will turn it over to Kevin Jacobs, Alvarez, and Marcel to begin our discussion of partnership audits. Over to you, Kevin.
Great, thank you so much, and thanks everyone for joining our virtual coffee talk. Again, I'm very excited that you all joined us for this presentation to discuss what are we hearing as far as partnership audits, what should people know about them. There's been some interesting, surprising twists and turns, and to that, I'm very excited to have my friend and colleague, Kat Greger. Worked with her many years ago, although she's still 21. A partner at Standard Arps, and as always, Kevin DeYoung is going to show us Answer Connect and all things we need to know at the end and how we're able to do efficient research. So let's dive right in because there's some really interesting tidbits I want to make sure that we get to, which is the agenda that we're looking to cover is we're going to review the partnership audit rules, and everyone's like, okay, well, I know about partnership audit rules. What's the big deal? And stay tuned. You may think you know, unless you've actually been through them recently. I feel like the goalposts keep moving because how the IRS implements some of the rules and the implications that it has is rather broad sweeping, so we'll touch on that. From there, we'll talk about the IRS and partnership compliance, both the large partnership compliance program as well as the key IRS campaigns, which I think will be really interesting to hear about. What is the IRS campaign looking at, and what is the implications it has on partnerships? And then lastly, we're going to turn to what to do when an audit starts, right? So we have an audit. What do we need to do? What should we be expecting and going forward? So with that said, we're going to launch right into our first polling question. As noted, please make sure you answer them so you can get CPE. If you don't get your CPE certificate for whatever reason, on the slide there was an email you can contact. But have you been involved in a partnership audit for a taxable year that began after December 31st, 2017? And obviously might be a reason why we use that date. So again, while you're doing that, we're going to start talking about the new rules. And so the new rules are important just to highlight because it actually may change the risk analysis in evaluating the tax positions. It impacts how audits are handled, who actually is involved, who may bear the tax associated with an audit. And it also carries through on due diligence. So if you're doing a transaction, what do you do as a buyer? What do you need or expected to do as a seller? What do your partnership agreements and documents say? And we're going to actually talk about this towards the tail end to say, okay, this is what we're looking at. What does the partnership agreement say? I thought this was the deal. Well, that's great, right? I mean, we've all talked about, we know what the deal is, but unless it's in writing, you may actually come to some unexpected surprises when all of a sudden an IRS audit comes in. You talk about tax protection agreements and financial statement reporting. Like this has broad ramifications, and there's a really interesting impact because you say, okay, well, it's only a partnership. I don't have to worry about it if I'm not employed by a partnership or I don't represent a partnership. And it's like, okay, well, are you a partner in a partnership? Do you make any investments in partnerships? It's actually really broad because you want to know not only what you should be doing, but then also what are your rights. So with that, Kat, what are some of the highlights of the new rules?
Yeah, absolutely. So we definitely would recommend that if people really want to understand the ins and outs of some of these things, that you sort of get in a time machine, or just go onto one of these wonderful websites and go get one of the really detailed explanations that folks have put out over the years. But what we want to do is just really give you a sense of some of the really key factors, so that when we're talking about now what happens when the IRS shows up, you guys have enough of a baseline to understand sort of some of the nuances that we're going to focus on. So first and foremost, audits at partnership levels are centralized. And for those of you who have dealt with partnerships for years and years, this isn't that different than the old system. The old system was centralized, and the audit, the examination of the partnership was done on a centralized basis typically. But that only typically related to adjustments of partnership items. Now the IRS has the ability to effectively collect against the partnership. And that is now the new default rule. And that is, from just a basic policy perspective, that was the change that gives rise to a whole slew of new procedural considerations. So first and foremost, it can shift liability of a partner's tax to a partnership. So first and foremost, you all need to understand that there are many circumstances where a partnership as a whole is going to end up paying the tax of a partner. And as Kevin noted, that can really impact the way in which a partnership agreement pans out, the way in which your capital accounts get affected. And frankly, by this point in time, hopefully, partnership agreements are contemplating this possibility. But if they aren't, it's something that will need to be dealt with and considered if it comes up on a pretty quick basis. Also importantly, and this may sound like the same thing, but it's actually really important to the IRS. It also shifts the burden of collection of partners' tax liability effectively to the partnership. So, and those are really two different things. The partnership can be forced to pay a partner's tax directly, but if they don't want to do that, they are actually going to have to do the work to aid the IRS in collecting the tax against the partners. In other words, those are the only two options that are on the table for a partnership that is subject to these new rules. You either are going to pay the tax on behalf of all your partners yourself, or you are going to do all the calculations, you are going to get all the relevant information, and you are going to give the names, addresses to the IRS and send a notice to the IRS saying how much every partner owes. And historically, if you were involved in any pre-BBA, so the old system, as I like to call it, TEFRA, if you were involved in any exams there, you may have experienced the anomaly of the IRS spending a lot of time auditing a partnership and looking at the sort of, making large adjustments, sometimes in the millions and millions or larger dollars, and then not collecting because they actually found it too complex to trace through to the partner level and figure out how much everybody owed. So we saw this happening where the IRS was spending resources and going after partnerships, but then not doing anything and not bringing in any dollars. And so that is really the thing that this is trying to fix, and that permeates the whole set of the rules. So just a couple little points to sort of note. It applies for tax years beginning after 12/31/2017. So for the most part, any audit that's starting now is going to be covered by these rules. I think the IRS, because of the pandemic, probably missed a cycle, pretty much missed 1 year. So we probably would expect them to start auditing the 2019 year at this point. I think 2018 tax years are closing as we speak. And so for new audits that are opening up now, we would expect them to be at the 2018 year and clearly in these new rules. Partnerships do have a limited ability to opt out, but it is, let me put it this way, if you're dealing with any partnership that itself has any partners that are pass-through entities, you will not be able to opt out. So these proceedings are going to apply to everything that we think of as a even moderately complex partnership structure. If there's a trust above it, if there's an S corp above it, if there's another partnership above it, you're stuck with these rules. And also just worth noting, the things that are covered by this rule is a very broad definition. It's any partnership item, anything basically reflected on the partnership return that could impact the tax liability of a partner up the chain. And that could be a direct partner or an indirect partner. And so very just one point to sort of make on that is that it could impact character, not just amount. So that's something that's important to keep in mind. If you called something capital gain and the IRS thinks it's a dividend, and that distinction impacts the tax liability of a foreign partner, that's going to be covered. Also, allocation between partners. So they may say you reported everything exactly right from a aggregate basis at the partnership level, but the way you divided it up amongst all partners, that of course will impact individual partners' tax liability, and so that of course is also covered.
Yeah, and it's really interesting. We're going to launch the next polling question in just a minute, but really it's a matter of saying what this does is it turns on its head the normal premise of, okay, a partnership is a flow-through entity is not a taxpayer, right? And so we'll discuss exactly, as Kat said, the partnership may actually become a taxpayer. So true or false, if I don't work or represent a partnership, I don't need to be worried about these rules. I've already given the answers, so hopefully you were paying attention. We'll start covering the adjustments, and the default general rule is partnership level adjustments. That's provided in section 6225. Under that provision, the partnership is actually liable, as Kat said, for the partnership adjustment. And so this becomes interesting for many respects. You'll have to think about, well, where does the partnership get the money? How does it impact all sorts of allocations and so forth? But just from a calculation standpoint, the IRS says, okay, well, we're going to take the partnership adjustment and multiply it by the highest potential applicable federal income tax rate and apply it there. So if, for example, you have partners that are at varying tax rates, the tax that would be due if they collected it from the partners would be different than that of collecting it at the partnership level. It's one of those things that was done, from an administrative ease perspective. These rules are not presumably going to be changed, even though the IRS just got a large slug of funding. And they were designed, as Kat said, to say, yes, we understand all of the difficulties associated with it, but look at us at the IRS. We can't track these things. We can't determine, and the administrative burden on us is so great that we're relying on what you did originally. You now figure it out. There is a process that you can use for possibly netting adjustments. It's rather complex. You should spend a lot of time in those rules and trying to figure out how they do it. There are ways of requesting modifications of a proposed underpayment by referencing to the partner's characteristics. But again, there is a lot of work that's necessary in order to substantiate it. It's not just saying, oh, well, this partner, here you go. You might need an affidavit. There's documentation that's needed. And so if you fall in this, you definitely need to figure out what documentation do you need, and are you entitled to get that? So that's sort of part of the information that we'll talk about later, as far as what do you do at the end of the day? What does the partnership agreement provide? What do you do? And so, Kat, I've talked about the partnership pays the liability.
Yeah.
There is this push out election. What should they know about that?
Yeah, and so, the way we sort of set it up, the broad stroke is, look, the default is a partnership pays. And that can be complex to get to the actual right number, and also, frankly, it can be impossible to get to the actual right number if you have a really broad base of partners and they're not willing to actually pull information into, for lack of a better word, of their own personal information into the partnership proceeding. And so one of the issues that we anticipated, like with the process of actually doing an imputed underpayment calculation, is you need a lot of information from your partners. You don't, at one level you need like W-8s and W-9s, but at a different level, if you want to actually say to the IRS, look, this individual had net operating losses, or they had other adjustments at their level that would have reduced it down from the highest tax rate. So say you actually had an individual whose income was relatively low and was in a lower tax bracket. The only way to prove that is to actually have that that partner provide information to the partnership representative, the partnership effectively, and have that partnership provide it to the IRS. In some cases, the IRS would even allow people to amend tax returns and provide certifications through the partnership level proceeding to reduce down to 6225. But a lot of partners were just really uncomfortable with this. So the IRS, I think, was aware that this was going to be an issue, and actually Congress in theory, because they're the ones who put this into the statute, and so contemplated an alternative. And the alternative is this push out election where it's under 6226, so it's sort of the next section. And they allow people to basically take into account adjustments on their individual tax returns, receiving sort of a special statement from the partnership, where basically the partnership has said, we've elected to push this out, and we're now sending a statement to you that is typically going to be included with the K-1 for the year in which this sort of resolves itself with the IRS. And we would sort of, that would be like very, many years after the actual year, the rate that we go, say 6, 7, 8 years after the year of the adjustment, the year that is being adjusted, what we call a reviewed year. Those partners may receive a notice from a partnership that they may or may not even still be a partner in, where they basically say, congratulations, 10 years ago, you missed some income, here it is. Here is the details on it. And the IRS is contemplating that people will then, on their individual returns, calculate going back 10 years and include the tax with their current year return, but there will be some way of calculating it. The IRS has issued a lot of regulations on this. I think a lot of you who are maybe even are on the phone, and I know it's a really broad stroke of people who are listening in, but if you're on the phone and you prepare individual tax returns, I think this is something that you really should be aware of, that with a K-1 that you might normally get, you just throw it in its current year issue. It may actually require you to go back and do the equivalent of an amended return 10 years ago and actually attach it to the back of the current year return, and electronically. I can't even tell you what that means. So it's definitely something to watch for and expect as a bit of a curveball in the next year or two. So for this, it's completely up to the partnership and really the partnership representative, which we'll touch on a little bit later. But partner consent's not required. So this may come completely out of the blue to a partner. And also something to really keep in mind is that interest is charged at a higher rate. So it's the normal underpayment rate plus 2 percentage points. So if you do get one of these, you're going to need to make sure that you are taking into account that higher interest rate, or the IRS will probably just kick it back to your client. And so you may be asking, gosh, this sounds like potentially two not perfect choices. And that's right. It is sort of certainly shifting the burden to taxpayers, making it easier for the IRS to ensure that they are getting what they want to collect. But one thing that they did introduce in the sort of final set of regulations is the ability for the partnership and the IRS to actually negotiate over what things get pushed out and what things are quote unquote paid for at the partnership level. And so what this means is that you've got, if you've got an adjustment that, is say, you've got a capital gain, issue that's sort of, directionally not going to result in much tax to the particular partners you have. You've got capital gain and it could be allocated to a collection of foreign partners and exempt partners, and we don't expect there to be any UBTI for the exempt partners. Then you might want to just say, we're just going to opt to quote unquote pay at the partnership level the tax on that capital gain, because we can prove that actually no tax is due, and then we actually just wipe that one off the table. And then you may say, look, the other adjustment is that you increase dividends, and for the dividends that you increased, actually with our collection of partners, some people may pay tax on it, some people may not. It may be a widely varied result and require partner level calculations. And so because of that, we want to push that one out. So you will be able to go to the IRS and say, look, we've looked at the numbers and we would like to do an imputed underpayment for these collection of adjustments, and for these other ones, we want to push them out individually. So it's just something to keep in mind that if you're faced with this, that is going to be something that you'll want to think about down the road.
Yeah, and we got a question dealing with, okay, well, what happens if the partnership can't pay it? And you're like, okay, well, for example, if the partnership has illiquid assets, and as Kat mentioned, right, this could be years after the actual tax year that in which the income arose. And so this might be a situation, even though it might be advantageous, even if the partnership has all the information, they may say, hey, let's do a push out election so we don't have to bear the actual cost. We don't have to liquidate our assets in order to make a payment. So that's just one of the factors that obviously comes in to the analysis. And it is interesting to make sure that making a calculated, informed decision as far as, okay, well, what do you or don't you want to say, I want to push out on this and a partnership level adjustment on that. But again, this is going to go to, I guess, we're sort of teasing this a little bit ahead of time of what does the partnership agreement provide? Can the partnership representative even say, I want to have a push out election? Do they have the discretion? What process is involved? But these are the level of adjustments. Now, Kat, I guess, I've heard that there's this AAR type thing going on, which we haven't talked about. So
yeah, and one thing just to comment on the what happens if the partnership can't pay. There's sort of two options. One is the partnership either pays and does what Kevin said if it still exists. However, it is worth noting that if a partnership has ceased to exist overall, or if frankly, if the IRS tries to collect against the partnership and the partnership does go bankrupt, the IRS will go to the partners, and they will look to partners and try to collect tax against the partners directly. The rules still apply to require that the partnership representative still communicate with the IRS to figure it all out, but effectively the IRS isn't limited in its ability to collect tax against the partnership. If it cannot collect against the partnership, it will go after the individual partners. Okay, so yes, let's talk about administrative adjustment requests, or an easier phrase, AARs. So AARs are not new. It's a term that was used historically to refer effectively in the regulations to any amended partnership return. However, historically, the way that you instituted an administrative adjustment request was to file an amended partnership tax return, just a 1065X. So now it's not actually how you do it. Now you actually have a form. You may end up attaching to it the equivalent of an amended partnership tax return, but there is a specific form for it now. A version of these rules will apply to an adjustment request. So if you were to say, we missed some income, we need to go file it, it used to be the case that you would send your partners an amended K-1, and they would theoretically have to go amend their returns. I know I will give a head nod to many of those listeners who are like, yeah, I never did that. I just included it in the current year because that seemed easier. That really was something that did happen a lot, and I think the IRS probably directionally was okay with that from what I've understood. But now you won't have the automatic option to do that. You still have to run through these rules. So if you say we forgot to report some income and you file an administrative adjustment request, you will then need to do a partnership level adjustment or a push out election. If it is something that is favorable to the partners, you don't just get a refund at the partnership level. Like, it's not like you can request cash in from your partners. It's a one directional toggle. If it is favorable to taxpayers and would not result in tax that is due, then it does automatically get pushed out. And so partners will get a notice that says we've adjusted it. But it, only if it's been an election, a formal election to push out positive adjustments that result in tax due, or an automatic, effectively an automatic push out if it's an adjustment that results in a refund to the partners.
Yeah, and a few other things just to note on the AAR is, Congress has made it known, right? They enacted a statute that pretty much says, okay, an AAR is not a tax return. That becomes relevant in several places. It's important just to know, as Kat said, is as part of the AAR, you do in effect attach a 1065X, an amended tax return. And so some people say, well, you're not technically filing a tax return. but part of it is a tax return. We have seen comments made to the PGP asking for further guidance with regards to AARs and the like. So really, it's a matter of saying we now understand that the rules have changed. And, you know, Kat, I'd be interested in getting your thoughts on a question that came in, which is, you know, they prepared and filed an amended return when they should have filed an AAR. What happened? And you know, from what I've seen is there have been instances where the IRS has actually processed the amended return. We sometimes refer to it as, you know, slipping past the goalie. But what you know, you're advising a client on this. What should they do? Because they now have this amended return. If you pull the IRS transcript, it shows the amended return. The funny part is if you go in for certain cases with the IRS chief counsel and you get private letter rulings, they say, oh, well, just attach this private letter ruling to an amended return, not to an AAR, but to an amended return. So there's still certain instances when you're supposed to be able to do it, but it's sort of with IRS discretion. But here, presumably, there wasn't this. What would you say they might want to think about?
Yeah, I mean, I think, you know, I think first think about whether it resulted in a refund or tax due. And if it was a refund and, you know, you sent out amended K-1s and people got their refunds and everything sort of seems to work out okay, I think you're fine. I think that on the flip side, if what you did was send amended K-1s to partners with an additional amount of tax due, and therefore you don't have any proof or verification that the partners actually paid it, that does theoretically create a hypothetical liability, right? If that partnership got audited for that year, the exam team sees the amended 1065 and they say, but where's your imputed underpayment? You didn't do an actual push out election. Then you could end up procedurally with some issues. And so I think step one is figure out the sort of lay of the lands, like, were we just getting a refund back? In which case the IRS is going to have a problem with it later. But if we owe tax, you might want to, depending on the size of the partnership, you might want to consider getting verification from individual partners that they included the tax, sort of the increased amount of income and paid the tax on it. That's a way you could protect the partnership down the road. You also could send a letter basically saying, you know, we did this. And I mean, frankly, you just send it to the service center where you file the return, right? So who knows if it goes anywhere, but at least you have a copy of it going in. And just say, we filed a 1065. Our view is that this was going to be treated as an AAR, and we have hereby elected to use the push out election, and we sent out amended K-1s. And basically just sort of protect yourself there and basically say we made a push out election. But what you don't want to have happen is send out K-1s and have the IRS come back later and try to reassess the same amount of tax at the partnership level. So I think you should talk to folks and think about what's the exposure to the partnership and what are some protective actions you might take.
Yeah, and you know, just to chime in, anytime you're sending something like that to the service, presumably you would want it, you know, certified return receipt, proof of mailing, as well as hopefully proof of receipt. I do feel compelled just to note, you know, as always, we're not giving, you know, legal or tax advice to any particular client, and so we are answering the questions and trying to give you some thoughts, but each individual case is subject to further development, and so we encourage you all to think about how it applies to you. So let's talk about the IRS and partnership compliance program. You know, there's two different prongs here, and I'm really excited, Kat, because we're doing really great on time, so we'll be able to hear all your insights on the IRS campaigns. You were like, I want to make sure I share it. I'm like, you'll be able to share it, don't worry. And so we have the large partnership compliance program, right? And this is similar to those that are aware of the large corporation compliance program. And as you can see on the slide, you know, it's pretty much like it runs through a program, and hopefully or presumably with the additional funding, the IRS will further increase their technology and fine tune the selection process. But it's sort of like, how many red flags do you have, or do you have something that's flagged as interesting, and congratulations, you're now selected, right? And so it doesn't matter if it is or isn't a campaign. It's sort of your whole return is under audit, right? And we've seen this in individual contexts of saying, okay, oh, what were some of the flags? Well, you had astronomical medical in the individual context when your income is really, really low. So that's like one of the red flags the service has indicated. So in partnerships, they say, okay, we have this certain type of criteria. When you file your return, it goes through. Let's now see what happens. On the other side, we have the IRS campaigns, and we'll talk about the campaigns in just a minute, but what it is it's a coordinated effort with respect to a specific issue. And I was at Chief Counsel before coming to A&M, and I was involved in campaigns, and it's really interesting to see how they're put together and the purpose of them. It's not just saying, okay, well, you fall under a campaign, you did something wrong. Rather, it could be you fell under a campaign, the service is trying to learn more about a particular area. How are taxpayers reporting this? What issues are they seeing? What is the approach to certain things? And so it's really, as you can see on the slide, it is a matter of saying, okay, education, what guidance do they possibly need to issue regarding this issue? So it's not, oh, you did something bad. It's like, okay, if I'm under a campaign, understanding what are they trying to get at? And normally when you're under a campaign, it's really limited to that campaign. So it's not like your whole return is under audit. Now, sometimes it creeps because they see something and they can possibly refer it out. But generally, when you're under this IRS campaign audit, they say, okay, I put blinders on to the rest of the return. I'm really focusing on this particular issue. It can include partnerships, but are not limited to partnerships. So this is really just a broad scope of, okay, this is an issue the IRS wants to know about. You have that particular issue on your return, and you'll see in just a minute when we go to the next slide about some of the key campaigns. Like, for example, 965 is up there. Well, partnerships aren't the only people that had 965s. We have corporations, we had individuals. So it was a broad reaching campaign. Like, there was a campaign associated with implementation associated with the Tax Cuts and Jobs Act, or TCJA. And everyone was like, okay, well, every return is going to have something presumably about TCJA because of the breadth of TCJA. What the heck did that mean? And so it was really an interesting discussion to see how does the IRS use campaigns and the implications it has on audits. So, Kat, on this slide, I know we highlighted some of the key campaigns, and I know you've sort of seen or been involved with taxpayers that have
Yep.
been involved in these campaigns. So I'll turn it to you to shed some light on it.
Yeah, absolutely. So we tried to pull out some of the ones that either are impacting partnerships, like Kevin said, amongst other taxpayers, but where we've actually seen this pop up on partnership audits. But also there's a few here that really are focusing on partnership structures. And so we'll focus, we'll cover those as well. But so starting with 965 and really 965 plus all of the TCJA focus on things like planning transactions before and after 965 was being calculated. But for those of you who maybe aren't in the international space all the time, 965 was that transition tax that was imposed as part of the TCJA, where primarily U.S. corporations or U.S. headquartered corporations who have foreign subsidiaries that are CFCs, they were sort of moved into a different tax structure. And as part of that, we have this transition tax where we had a deemed repatriation of all the historic earnings and profits that had not already been taxed. Those calculations are complex. It involved a lot of different code sections, not just 965. And without going into way too many details, there are a lot of places where there was ambiguity around things like effective dates of the different provisions and how things like EMP should be calculated historically. And so the IRS recognized pretty early on that this was, while it was going to be a one-off tax, it was going to be one that was going to come with a lot of uncertainty, a lot of ambiguity, and taxpayers taking a wide variety of positions, to put it nicely. So as a result of that, one of the earlier efforts coming up, after the TCJA was to start looking at people's calculations of their transition tax. This was the end of 2017, and so you would think that it's worked its way through the system now, but in fact, it has not. In large part because there is a 6-year default statute of limitations for the actual calculation of that tax. And for other folks, some folks, it ended up sort of affecting later years as well, but just at a very basic level, they are working their way through different types of taxpayers in rounds. And maybe late last year, they had sort of moved on to partnerships, if you will. They had focused primarily on large corporations who had interest in CFCs, and their next round, and individuals as well. Actually, they had 2 different campaigns running simultaneously for individuals and business entities. But for the business entities, they did corporations first and spent a few years doing that, learned a lot. And now we're moved on to partnerships. So we are seeing a lot of partnership audits. Interestingly, these are under the old rules. This is actually a pre-BBA tax. And so those audits we're seeing are actually still living and breathing under the old procedural rules. So that is something important to know if you have a 965 audit that pops up for a partnership. For any of the large partnership compliance campaign audits that we're seeing, we do expect that all of the rest of the TCJA issues, if that partnership has foreign investments in foreign entities or itself is a multinational entity, we do expect that all of the TCJA topics will be of interest in any large partnership audit. And so at a very broad level, if you've got a partnership that is quite large and complex and has international activities, I think you should expect there will be a review of related party, for example, related party interest payments or any related party payments. There will be a lot of focus on whether there were or were not CFCs in the structure and if there should have been sort of ongoing guilty inclusions, that kind of thing. So I think, you should be prepared for those issues if you've got an audit starting. I'm going to go to the next few are actually pretty partnership focused. So I'm actually going to bop around on these things, but the sale of partnership interest and losses or distributions in excess of a partner's basis are actually relatively related. I think that early on in thinking about areas where there potentially was enough complexity that people just aren't getting things right, which is, I think, frankly, 99% of the time when something is not done correctly in a partnership structure is just really a result of the complexity of the partnership rules, but also where people might be playing games with things like basis and partnership basis and just the partnership rules generally. And so the IRS launched 2 campaigns looking at sales of partnership interests and in large part focusing on the calculation of basis in a partnership context as part of that sale, and losses or distributions in excess of a partner's basis. So not a full sale, but if you were to pass through losses or make distributions, obviously if you pass through losses that were too large, they should be limited in a partnership context. In other words, you should not be able to take losses in excess of your basis or if you're an individual, the amount that you have at risk in that partnership. And so I think the IRS felt like there's a lot of confusion about these rules. People maybe aren't applying the limitations, and so wanted to focus on that. But also, as part of that, they're also looking at situations where distributions are being made, potentially also exceeding basis or amount at risk, and where that should result in a distribution in excess of basis would result in a gain recognized to the partner. And there was a perception within the IRS that conceivably was being underreported. I think for these 2, what I've seen is it's a little bit more educational. I think that they've got computer systems and AI that has flagged potential returns that maybe, show large distributions but no gain. Or an example would be like an actual sale of partnership interest where the amount of gain felt relatively small. And so they had AI that was flagging returns. And in large part, it seemed like the exam teams have been in education mode and are ticking and tying through things. But we haven't seen a lot of assessments coming out of these, except where there was just a more of a basic error. So that's sort of highlight number 1. I think coming out of this, we probably will see some focus on specific types of transactions. So one of the transactions that we've seen the IRS really focus on a repeat basis is where there is a distribution to a partner in advance of the admission of another partner, or a sale of part of a partner's interest to another partner, a combined distribution and sale, or a combined distribution where there could be sort of deemed sale issues, or where a partner may be trying to take out all of their 100% of their basis through distributions prior to selling, a material portion of their partnership interest. And so those transactions, I do think we are going to see potentially evolve into something that is a more rigorous examination process, whether that's part of a formal campaign or just part of the overall focus on partnerships. I don't think we know.
Sorry, Kat, just to chime in.
Yeah.
I mean, losses are obviously something that's really big in the partnership realm. There's been a lot of discussion, especially when TCJ came out, as far as in 163J, do you or don't you qualify for the exceptions under 163J? And there's the small business exception, but then there's the, okay, how is the allocation of losses and so forth. So the IRS is really attuned to, the losses and the potential mixing bowl or disguised sale transactions that you're mentioning. And, just quickly to jump back on 965, fully agree that, even though the campaign they originally had both 965 and then they had a TCJA, and then they're like, okay, the TCJA is sort of stopped. From what I've heard, the 965 still picks up, or they may still look at the TCJA. And I was at the service when TCJA came out. Kat promised that she wouldn't thank me publicly for all the guidance that came out for it, so I'll just fall on my sword before she gets the chance to do it. But it's a matter of the service really trying to understand, and this is really key for the campaigns and why we said like it's educational in part, trying to understand what taxpayers are doing. It's not just okay, there's certain circumstances where taxpayers are doing something wrong, where, for example, the losses in excess of partnerships basis, like saying, okay, you get to deduct this, that might be a problem. Here it was like, okay, well, the law is still somewhat new. What are people doing? How do you report it? And on the 965, in addition to the extended statute, you also have the ability of deferring the payment of the liability for over several years. So this is something that is going to be a long time coming. Still wait and see, but it is important just to keep those things in mind. Like, if you see something that's a campaign that may be applicable to you, I wouldn't say, oh, well, you're doing something wrong, but you should also say, well, I might have additional scrutiny of my return because I'm falling under this. So even when you're preparing the return or thinking about something, you may want to have additional documentation or additional belt and suspenders so that if you did get selected for a campaign, they are focused on this. It's not like a fishing expedition of like, well, we really don't have an idea if you have an issue. They're looking at this particular issue. So you want to be able to say, okay, why did you do this allocation? How did you report this thing? You're like, okay, I'm ready. Here you go. Go away. So that keep informing us. We're ready for your insights on the other ones.
Yeah, no, it's great. So I'm going to take lending activities and the Saga tax one together, because I think that they're both illustrative of how campaigns can kind of work out really differently. So the Saga tax campaign is actually really narrowly focused on a position that the IRS really directly knew that people have been taking and had been auditing people for years on, and that is the reliance on the limited partner exception to self-employment tax. So for those of you who are sort of, preparing returns in sort of with small businesses, this may actually come up quite frequently, where if you've got a business structured as a limited partnership and you've got limited partners in that limited partnership, 1402(8)13 says that self-employment tax is not due on the allocable share or distributive share to that partner. And so in a sense, you could have a world where you've got a service partnership that is primarily the result of people's personal services. You could, it doesn't need to be brick and mortar, it could be a consulting company, it could be anything. And if you've got a general partner and limited partners, the limited partners distributive shares by the plain language of the law should not be subject to tax. The IRS does not like this rule. They feel like both people abuse it and plan into it on the one hand, and also feel as if it just actually shouldn't be the case that it was enacted during a time when the definition of limited partner was very different than it is today. And so they have for years audited it on a one-off basis and decided to launch a campaign that was just really focused on enforcement. They identified 150 sort of partnerships, primarily in the asset management space, who were providing financial financial advisory. So primarily managers of hedge funds and private equity funds, real estate funds, where they received material portion of their revenue through management fees for providing those services. And basically just universally are taking the same position across most of those taxpayers. We've sort of seen right now, I think every law firm I know who sort of has the same practice as I do, we each have about a dozen of these. Sort of adds up to about the 100 that they started, and as a result, we're seeing these now flow into appeals and flow into courts at the same time, which is, I think, really interesting. I don't know that I've ever seen sort of that when you say campaign, that actually in my mind is actually what I was envisioning it would look like, almost like a militaristic campaign against a certain issue. The lending activities one is pretty different. So for lending activities, the IRS is aware that that there are a lot of blurred lines about when engaging in lending activities in the US could create a US trade or business. And so the IRS has for years understood, and Kevin can probably jump in with some of his own experience in this area, both before, after, and during his time at the IRS. But I think it is generally understood that this is an area where there's a lot of ambiguity and a decent clip of positions, like a pretty wide variety of positions. I'm getting distracted by the next question, which is funny.
There you go. Well, and I launched it just because I know it's important for us to save time on the time-sensitive actions. You can see the polling question on there, which really relates to what happens on an IRS audit, just to jump in, which is, in the following sentence, there are 9 dogs and they're all chasing their tails. Which one's their favorite? And, really just talking about the key first steps to examine the partnership agreement, which is, why is that? How does this relate to the polling question? You really need to read the you really need to read the partnership agreement closely and thoroughly to make sure that you're really understanding all of the rights. Is there typos? Is it really providing everything? Like typos, okay, I can ignore it, right? We made a funny ha-ha on the polling question, but if you really don't look at it, you really don't know what the rights are. We've talked about the partnership representative. This is the person and the only person, right? The only party the IRS is required to communicate with in the partnership audit. And it's the only person that can bind the partnership in an audit. So when you're picking who the partnership representative is, you have to think about that. Like, are they going to do the job? Are they going to do a good job? Do you trust them? Are they going to be around for a while? There are requirements as far as who can qualify as a partnership representative. And so really, it's a matter of making sure that the partnership agreement is providing for the partnership representative and all of the rights associated with that. You can see the reference to partners' rights, right? It is contractual, not statutory. So if partners want a right to information or decision-making as part of the audit, if the partnership agreement doesn't say it, they have no rights. It really has to be in there. And so when you're thinking about these things, you really want to make sure that it's no longer just, oh, I have a partnership agreement, it's a piece of paper. What does it really specify? Because if you get caught up in these rules and you're like, oh, we have this understanding, well, guess what? At the end of the day, partners can't limit the authority of the representative. The partners can define what their authority is, but again, they have to do so in this agreement. And again, information sharing. We've talked about what information they get and what information has to be provided. I know I rushed through this because really, Kat, this is where I think it becomes really interesting, and we have just a few minutes left, which is the time-sensitive actions with the IRS. What should they know?
Yeah, absolutely. And so first, I think, one point as we're jumping into this is to keep in mind is that many partnership agreements are actually drafted before these rules came into effect. And some of us did a good job of actually convincing clients that they should just amend all their partnership returns, but in other cases, sort of, people made a business decision that it wasn't worth amending partnership returns. And so you both need to think about what you have in the partnership agreements that could require action of a partnership representative or a partnership. But you also need to potentially reconcile provisions that relate to code sections that don't exist anymore. So I think just to say it, you may not know if you're representing a taxpayer before the IRS and a partnership audit starts. We really, you just might not know what's in there, and you're going to need to take some time thinking through that really at the beginning. So that's sort of first most important thing. But there's also a limited set of actions that you need to think about taking really quickly at the beginning of an audit. So first of all, if you have a designated partnership, which, to be clear, I think, sorry, a designated partner. So Kevin mentioned that you have a partnership representative who has all of the authority. The way the rules work, you have a partnership representative and you can have a designated individual that is associated with that partnership representative if the partnership representative is itself an entity. And in effect, that individual on behalf of the partnership representative or just the partnership representative directly have unfettered sort of authority. So you can imagine a world where you have a friendly partnership at the outset and you designate a person and that person actually has been pushed out or left and potentially left on negative terms. So if you have a partnership representative that is not someone who you actually want talking to the IRS, that is like first and foremost step one, because you cannot redesignate a partnership representative until an audit starts. So really the very first thing you need to do if you have a partnership that is under audit and you have a partnership representative that's not who you want, you need to go get it fixed first. And then second, the limited window, you have a limited window between notice of intent to audit and an actual notice at the beginning of audit. This is really important. The IRS created this procedural window to allow partnerships to file AARs. Once the audit officially begins, you cannot file an affirmative AAR. And if you have issues that you think are in your favor that you want to actively put in the equivalent of a refund request on, you need to do that in that window. So step one, make sure you've got the right partnership representative. Step two, make sure that if you've got any affirmative adjustments you want to make, you're doing it in that window immediately. And so we wanted to flag these things because honestly, this is new to all of us. And many of you might not know that this is even a possibility, and you might just wait for the next notice and then figure out what happens after that. So Kevin, I know I don't know if we want to talk more about this stuff or if we have any questions that are left at this point. I want to check in with you on timing because we're nearing the very end.
Yeah, no, so I think we addressed most of the questions that we got in. Some of them date back to the AAR section, so unfortunately we're not going to revisit that, and I want to make sure that Kevin DeYoung has a chance. I do want to stress, again, that there is this period, you do need to look at the partnership agreement. You should really, if you haven't looked at it since the BBA, you should, just pick up the partnership agreement. Now is the time to fine tune it. You don't want to wait for an IRS notice to start saying, okay, here you go, what should I be doing, what are my rights? Because as noted on this slide, once the audit begins, AARs are done, you're sort of locked into, okay, it becomes a lot harder to say, oh, I now want all of these rights when, the process has already started. I want to take the time, to thank Kat. It was exceptionally helpful. It's always great presenting or working with you. If people do need a law firm, so she's actively involved in this space, highly encourage you to reach out. If there's any questions that you have, feel free to reach out to us. I'm going to turn it over to Kevin DeYoung to talk to us about AnswerConnect.
Thank you, Kevin. And Kevin.
Thank you, Kat. Thank you, Kevin. Can we have the share screen transferred over to me, if you wouldn't mind, please? Excellent. So as we've just heard for the past 50 minutes or so, a ton of information out there on this specific topic. I've been given a few minutes here to kind of give you a really quick overview of the CCH Answer Connect platform and kind of why we built this before we get into the actual content set that's related to the coverage that we've just seen. CCH Answer Connect has been out for several years, and it's actually a newly designed tax research platform that allows the user, whether they're more experienced in terms of being able to digest code and regs and more complex explanations, or whether they're newer into the research area and they're more topically driven, keyword searching versus that code sections. So we wanted to be able to create a platform that would be viable for both users, as well as work into the tax research workflow that we watched as we developed this program and looking at all of our different users. So having said all of that, I think today what I'd like to actually take a look at is we spent some time talking about Code Section 965 and the transition tax. And I thought for example purposes today, we'd actually use that as our example. So I'm actually in CCH Answer Connect now, and I'm at my keyword search, and I'm just going to simply type in that transaction tax as my search example. And a couple things that you'll notice that start to happen as I begin to do this is it begins to actually populate it. I'm sorry, I wanted transition text if I can spell. There we go. The system actually begins to populate different areas within the CCH Answer Connect platform that will begin to drive the research into the area of interest that they're looking at. Again, we could go in via code section here, but again, I'm just using this as an example as a keyword search, where we begin to put in questions and answers, a very high level overview of what the transition tax is all about. If you need to click into more information, you can. As part of the launch of CCH Answer Connect, we also spend a great deal of time in creating what we call topic pages, where we're going to give you a very high level overview initially of the actual topic in question, with the ability to dive deeper into the content as you see fit as it relates to the issue you're dealing with. So as we wait for this topic page to draw, I want to also mention the left navigation bar. This is actually where we spent quite a bit of time focusing on tax research workflow. How do you get from point A to point B to point C as you work through the process of research? And CCH Answer Connect was designed to help the researcher do that regardless of their level of expertise within tax research. So as we look at our transition tax on accumulated foreign earnings, we're going to give our editorial team has curated this topic page, which covers the specific issue at a very high level in terms of getting your feet wet, getting an understanding of what the information is all about. Everything here in blue will actually hyperlink you into different areas of the service as you go through the process. I'm actually going to use my left navigation bar to click on my recommended topics, as this will now take you from that high level overview into a deeper dive into the subcategories within the transaction tax area. From here, then, we also brought over the key primary source for those that are interested in the transition tax but don't know that it's tied to 965. We give you that information. Again, as part of the research workflow, we've also brought in any client letters, if there's forms, if there's instructions, if there's work papers, decision trees, all of that will be brought in here as well as any view into IRS publications that we have out there, and then finally into any additional CPE if as a researcher you want to do some additional continuing education just to broaden your expertise in this area. I'm going to hop back over to my key primary source and jump into code section 965 as we continue the research process. And what I want to focus on again here is that research workflow. What you'll notice is we've gone through a tabular view from left to right, where we begin with the code section. From here, we bring you into the regulations related to code section 965. And if you think about how traditional digital research has been done, every time you were to click on one of these additional regulations or the code sections, we would take you to a different area of the service and leave this page. What we saw as we did the research in building Answer Connect, that there was frustration levels in terms of getting lost. So again, wanted to focus on that workflow, bringing you the explanations and information that the CCH has drafted them for you. Any type of cadence, administrative guidance, rulings, annotations are also here. Our pubs, The forms instructions, we talked about that briefly. The tools, again, are being brought here directly for your view. Client letters, tables, there's a host of different information here. We also then bring you into that federal state comparison. So if you need to transition from the federal topic and take a look at the state in which the transaction or the partnership in this case is it dwells, you have that ability. And finally, you also then go into our More tab where we're going to have information from our journals, from the treatises that we have available regarding that specific content. So again, I know this was a very fast overview of CCH Answer Connect. I think we can pull up the next polling question as we wrap up here. But again, would love the opportunity to discuss this further with anyone who has not had the opportunity to take a look at CCH Answer Connect.
Okay, thanks, Kevin, for that demonstration of CCH Answer Connect, and a thank you to Kevin Jacobs and Kat Greger, our panelists, for a great and informative discussion today. This will be the final polling question. Would you like a more in-depth demonstration or further details on the resources and tools available in CCH Answer Connect? This question will remain up as we wrap up today's event. The virtual coffee talk will conclude once this polling question is completed. As a reminder, there will also be a few quick survey questions for you to complete following the webinar. For anyone who answered at least 3 of the required polling questions and stayed connected to the entire webcast, you can expect to receive an email within 5 business days with instructions on how to access your CPE certificate. Please note the instructions will be sent to the email you used to enroll for today's event. Thank you all for attending our August virtual coffee talk, and we will leave that question up for another 30 seconds. And this concludes our webinar today. See you next time.